Let's talk about the financial industry. On one hand, it's this incredible engine of progress, right? It's funded everything from the Industrial Revolution all the way to the smartphone you're probably holding right now. But it's also the architect of some of the most devastating economic crises we've ever seen, wiping out life savings in the blink of an eye.
So you've got this huge paradox. It really makes you wonder, doesn't it? How can the very same industry build up entire economies and then turn around and destroy them? That's the core question we're going to tackle. Let's get into it.
Okay, so think about it like this. On one side, you've got the promise, right? Finance is what funds innovation, it sparks growth, it's supposed to allocate capital to the best and brightest ideas. But then there's the other side, the peril. It's the engine behind global crises, it widens the gap between the rich and poor, and yeah, it's a place where people's life savings can just vanish. It's truly two sides of the exact same coin.
So to really get our heads around this whole paradox, we have to rewind a bit. We've got to go back to the beginning and look at the original blueprint for what finance was even supposed to do.
At its core, the idea is actually incredibly simple. Finance is basically supposed to be a middleman, an intermediary. Its whole job is to take money that's just sitting around, people's savings, and funnel it toward productive stuff. Things like starting a new business or building a new home, things that create real, actual value in the economy.
So when it's working like it's supposed to, it's this simple four-step process. Step 1, savers put their unused money into the system. Step 2, finance, our middleman, steps in. Step 3, it directs that money, that capital, to productive ideas. And the result? Step 4, society benefits. We get new value, we get growth. I mean, when it works, it really is a beautiful system.
And you know what? For a long time, it really did work like that. I mean, finance is what funded the huge game-changing projects of the Industrial Revolution. But then, something started to shift. In the 20th century, the focus moved from funding production to funding consumption. You see the rise of consumer credit for things like cars and appliances, then credit cards become a huge thing in the 80s, and now look where we are. Household debt has ballooned from just 24% of GDP back in 1950 to over 73% today. That is a massive change in what finance is doing.
But somewhere along the way, things kind of went off the rails. A great disconnect happened. The industry just started to balloon, growing way, way beyond its original job. It started serving itself, really, more than it was serving the actual economy. There's this fantastic analogy from Rana Foroohar at the Financial Times that just nails this point. She says to think of finance as the tiny, narrow part of an hourglass. Its only job is to help the sand, which is our savings, flow smoothly from the top half to the bottom half, where it can actually be used for something productive. It's supposed to be this small but totally essential connector.
Okay, but here's the thing. That tiny connector isn't so tiny anymore. It's become this giant, bloated system. And get this, just look at this breakdown. Today, a staggering 85% of all the money flying around the financial system is just being used to trade stuff that already exists. Stocks, real estate, whatever. Only 15%, just 15, is actually going to fund new Main Street businesses and projects. I mean, that is a wild departure from its original purpose.
And what has this massive disconnect created? Well, a lot of people are calling it the casino economy. It's become this giant zero-sum game where new value isn't really being created. Instead, existing wealth is just being shuffled around from one player to another.
And look, it's not just critics saying this. We're talking about Warren Buffett here. The guy declared that financial markets have become, and I quote, almost totally a casino. When one of the most successful investors on the planet says that, you have to stop and think, okay, the game has seriously changed.
You know that little disclaimer you always see on trading platforms? The one that says something like 80% of traders lose money? We kind of gloss over it, but think about what that really is. It's not just fine print. It's basically the financial industry's version of the smoking kills warning on a cigarette box. It's them being legally forced to admit just how dangerous the game can be.
So, how does this casino actually work? Well, it all comes down to a concept called asymmetric information. It's pretty simple, really. In a fair game, symmetric information, everybody has the same knowledge. But in a rigged game, asymmetric information, one side knows something the other doesn't, and modern finance has become an absolute master at creating and taking advantage of those gaps.
And believe me, this isn't just theoretical. This rigged game has a real tangible cost. Just take high-frequency trading, for example, where supercomputers are making trades in fractions of a second. That practice alone is estimated to cost regular investors $5 billion every single year in the stock market alone. That's not creating value, that's just a high-tech tax being skimmed right off the top.
Okay, so let's talk about the fallout. The consequences of this massive, self-serving financial system. They ripple out and affect everything. Remember that analogy of oil in an engine? That's exactly what's happened. What was supposed to be a simple lubricant has turned into a catastrophic flood.
And that flood is causing at least two huge problems. First, you've got a massive talent drain. So many of our brightest graduates are being pulled into finance instead of going into fields like medicine or engineering or teaching. And second, it's just dramatically widening inequality. The whole system is basically set up to reward people who already own things, assets, not the vast majority of people who earn their income from a job.
And wow, this chart really puts it in perspective. Just look at this. Since 2010, the US stock market has grown 3.5 times faster than median wages. Now that's awesome if you happen to own a ton of stocks. But for most people whose main source of income is their paycheck, they've been left in the dust. I mean, it's not even close.
So this really gets us back to the heart of the paradox we started with. Let's be clear, finance itself isn't the bad guy here. It's absolutely essential. It's the oil for our economic engine. But like with any powerful substance, the dose is what matters. A little bit is essential, but when it floods everything, it becomes toxic and the whole engine just seizes up.
So when you boil it all down, the problem isn't that finance exists, the problem is its sheer enormous size and how its purpose has gotten so twisted. It really is a case where the poison is in the dose. And that leads us to the big, final question we have to ask ourselves. Has the dose already gone way, way too far?